Now we have to move on to the second part of this chapter, which is are related to short-term financing and planning, part two. The main ideas we're going to talk about here, we already discussed, but here we are focusing on cash budget. Now, cash budget, forecast of a cash inflows and outflows over the next short-term planning period. It can be 3 months, it can be 6 months, or a year base as well. But cash budget is the objective is to find out how much cash is going to inflow and how much cash is going to outflow from the business. And we already discussed the sources and uses of cash in our first part. Primary tool in short-term financing planning. This budget is going to be helpful in making financial planning, short-term financial planning, and help determine when the firm should experience cash surpluses and when it will need to borrow to cover working capital. It's also give us that in which quarter of the year we have to borrow and in which quarter of the year we have a surplus to adjust our short-term debts. Allow company to plan ahead and begin the search for financing before the money is actually needed. So because the budget is already prepared in advance and they know that we need this much cash in this particular quarter, so they already find out a debt for debt for that particular period, short-term finance or short-term debt for that particular time period. Pet treat corporations specialize in gourmet pet treat and receive all income from sales. Estimate sales so this is an example of a cash flow, cash budget. In order to understand the whole idea of a cash budget, so we are talking about a pet treat corporation. So their sales revenue, estimated sales revenue in 5 different quarters, like 4 for this year and 1 for the next year. 5 quarters are like this, like 500, 600, 650, 800, and 550. Accounts receivable beginning is 250 and average collection period is 30 days. Accounts payable beginning, how we have accounts payable, purchases 50% of the next quarter sales that we have to purchase in advance, the inventory, 50% of the next quarter sales. And beginning payable is 125. Accounts payable period is 45 days. Other expenses, wages, taxes, and other expenses are 25% of sales. Interest and dividend payments are $50 per quarter. And a major capital expenditure of $200 is expected in the second quarter. So these are all the information that what we need to know to make a cash budget. Now we started what is APC, average collection period, APC, ACP, average collection period is 30 days. So if average collection period is 30 days, so it means that 2/3 of the sales of a quarter is going to receive within that quarter. 2/3, because a quarter is of a 3 months. So if we see that the first month sales is going to receive in the second month, and the second month's sales is going to receive in third month, but third month sales is going to receive in the fourth, which is the next quarter. So it means that 2/3 of the quarter sales is going to be received, collected within that quarter, and 1/3 is going to be collected in the next quarter. And we also going to receive the beginning receivables based on 30 days collection period. So beginning receivables of 250 will be collected in the first quarter. So definitely this is the last quarter's 1/3, which is 250. We're going to collect it this quarter, plus the sales of this quarter. 2/3 of the sales of this quarter is a cash receipt, right? So cash collection. So cash collection is the receivables of the last quarter, which or beginning receivable, which is 250 plus two-third of the this quarter. So all together is going to be the cash collection. So we are making so it's a beginning receivables like 250. We started with the here with this 250, and that's is this amount which is given very clear. Now sales are 500 for the quarter, 500 for the quarter. And how much we're gonna cash collection? Now cash collection, as we mentioned, if we calculate two-third of 500, two-third of 500. So just I need a calculator just here. So 500 multiplied by 2 divided by 3. So we get it 333.33. So we ignore the decimals in order to make it simple. So 333 plus 250. So it's going to be 583. So this is 583 what we are getting. And how one third of 500 is our ending receivable. One third of our, so 167. This is one third of our receivable. Now this is the ending inventory, and that's going to be the beginning inventory for the next quarter. The sales for the next quarter is 600, and two-third of 600 is 400. 400 plus 167 is 567. And out of 767, we are collecting 567. It means 200 is a leftover. So 200 is our ending. Sorry. 200 is our ending, which is a beginning for third quarter. And we see the sales of the third quarter is 650. Again, two-third of the 650 is 433 plus 200. So 633 is our collection in the quarter, and 217 is a ending inventory, which is a beginning inventory for the fourth quarter. Fourth quarter sales are 800 and two-third of the 800 plus 217 is 750, and 267 is our ending inventory. So this is what we calculated based on our information. So basically what we calculated here is that how much each quarter we are getting cash. So this is a cash inflow through sales and collection from our accounts receivables. So payable period is 45 days. 45 days means after out of 90 days, if the payable period is 45 days, it means half of the payment should be made within the quarter and half on the next quarter because of 90 days. So half of the purchase will be paid for the each quarter, and the remaining will be paid the following quarter. So we see here that the beginning payable is 125. So how much we have to pay within a quarter? That's a cash outflow. So we calculated cash inflow, which is from the receipt from revenue, sales, and collection from the accounts receivable, because we are assuming that all the sales are on credit. So whatever the cash we are cash inflow is all from collection of accounts receivable. Now we are also buying our inventory on credit, so all the payments are going through the payables, accounts payable, and the rest of the things are like an interest and dividend or wages, which are separate, which we are paying directly cash. So payment of accounts receivable, we see that it's 125. And then how much we have to pay, and that is we have to calculate it on the basis of this information. Like purchases are 50% of the next quarter. So 50% of the next quarter sales. If we look at the sales here, next quarter sales is 600. So 50% of the next quarter sales is 600, means 300. So we purchases 300 on credit, and out of which 50 we pay right away. So it means we are paying 150. So we see here that 150 plus 125, which is a beginning one. So we are paying actually 275. plus wages, which is already given information, interest and dividend. So altogether cash disbursement or cash outflow is 450. Same is the case with the quarter two payment. We started with the uh, ending balance. Ending balance is 150. You know that sales of 600, 50% is our purchases, and out of 50% we already paid, and the 50% is outstanding. So 150 from the beginning payables, and the next quarter sales is 650. So 50% of 650 is 325, and out of which we are paying half, so it means 167. So 167. So we see that how much? 150 from the previous quarter, 100 and 167. So if you add up this all together, so if we divide it, sorry, I want to make it more clear. So what we said is that next quarter is 650. So 650 divided by 2, uh, divided by 2. So we get it 325. Then we again half of it. So we are dividing again this with 2. So it's 162.5. This is 162.5 plus 150. So we get it. I don't know what I'm doing. So 6, yeah, 0 divided by 2 divided by 2. So that's going to be. So what we are paying? We are paying 438 for accounts payable. 438 and 362 and 338. These are the accounts payable for each quarter. And then we are making payments of wages and interest and dividends. And this is the only quarter where we have to do some capital expenditure. So altogether, we see this. These are all values what we are getting here. Cash outflow, cash outflow. Now this cash outflow, we make it now broader. Cash collections or cash inflows, these are from our first table, and cash disbursement or cash flows are these are from our second table. And then we subtracted, we see that cash inflow, net inflow is positive in the first quarter, negative in the second quarter. This is because it's a negative 271, positive in the third quarter, and positive in the fourth quarter. Now, beginning cash balance, we know that we have $100 in the beginning, and net inflow is 133. So overall ending cash balance is 233. So minimum required cash is 50. We want that it should be of a 50 level. So we have an excess, or we can say that we have a surplus of 183. So then what we did, we did the same thing in the second column, and we see that we have a negative 88, and then we have a negative 30, and in the final fourth quarter, we have a positive 162. So this way you see here for a first quarter, we need to place this 183 cash so that we can generate some interest on it. And for these 2 quarters, like quarter 2 and 3, we need to arrange the short-term debt of 88 and 30. If these numbers are in million, then make more sense because it's 38. So and then again in the fourth quarter, we have to arrange for 132. This is what we call it as a financial planning or financial plan. So we see here that we have a cumulative deficit surplus, and we beginning short term change in there is no change. So we again bring this to 33 in the beginning and adjust We have a 88 plus, and then we arrange. So beginning cash balances, these are beginning cash balances, net cash inflows, short-term borrowing. Here we borrow 88 dollars. Interest on short-term borrowing, what we have to pay on these $88 borrowing, and then short-term borrowing repaid. Out of 88, we paid 55 in this third quarter. And then what we ending cash balances are like 233, 550, 50, and 178. So that's our target, that the minimum should be of 50. So here we achieve that target, that minimum is below the not going below the 50. So we can say that short-term borrowing is operating loans, committed versus non-committed. We can arrange if we go for borrowing, there is a possibility that uh, we can operating loans, committed and non-committed, letter of credit, that is also way of borrowing, accounts receivable financing, that is also a way of borrowing, factoring to sell the accounts receivable to third party, that is also a way of borrowing, and securitizing the receivable, that we convert the receivables into bonds and sell it against that security of their bonds to the public, and inventory loans. That is also possible, that we can borrow against our inventory. We call it as an hypothecation of the inventory to make a loan. So these are different types of loans we can arrange in the short run to cover the deficit in any quarter. It can be a operating loan, it can be a letter of credit, it can be accounts receivable financing with the covenants, factoring, securitization of receivables, or inventory loans, or trade credits, or money market financing. So these are all the financing. Now, for example, the bank is demanding in a way. So bank is deciding in a way 50, 100, 500,000 operating loan with a 15% compensating balance requirement. So now compensating balance requirement is that you borrow in such a way that 15% must be keep in the bank account. So the quoted interest rate is 9%. We need to borrow 150. So if we need to borrow 150, uh, we actually need to borrow 150 plus 15%, so that we can use 150 that's 15 150,000 into 1 minus need to borrow divided by 1 minus 1.5. Need to borrow 176.471 because that's a compensating balance of 26,471. What interest rates we are effectively paying? So we have to pay interest on 176,471, not the only 150. So if we pay interest paid 9% on 174,471, so we calculate the amount is 15,882. Now, the effective rate we can calculate is divide this 15,882 with the actual amount required, 150,000. So we see that the rate of interest what we are paying is not 9%, we are paying actually 10.5. Factoring can also be possible, and as I mentioned, that factoring is selling of the accounts receivable to the third party. So last year, your company had average accounts receivable of 2 million. Credit sales were 24 million. Your factor receivables, by discounting them 2%, what is the effective rate of interest? So we see that how much we receivable turnover is 12, like 24 is a total sales, average is 2 million. So we can say 12 times. What is the average collection period is 30 days, 30.4 days. And APR, the average rate, annual rate is 12 into 0.02 divided by 98. So we see that it is 24.49%. But if we want to convert it into effective annual rate, so we have to take that it is going to take 12 periods. So that makes it that effective rate into 27.43. So these are the formulas we already learned in our introduction to managerial finance. So I'm not repeating those. What is the difference between APR and EAR? So you already know those things. So how do we compute the operating cycle and cash cycle? We already know that operating cycle is inventory period plus accounts receivable period. That's our operating cycle. If we want to find out cash cycle, we have to subtract the subtract the payable period out of this operating cycle period to get it a cash. Flexible short-term financing policy and restrictive. In a restrictive policy, we are more emphasizing and to keep the low current assets, but uh, in a flexible short-term financing policy, in a flexible policy, we borrowing more for a short-term assets as compared to in a restrictive policy. So what are the key components of cash budget? What are cash inflows, cash outflows, and then we have to see the short-term side. So short-term financing involves short-lived assets and liabilities. Current assets and current liabilities arise in the short-term operating activity and cash cycle of the firm. So managing short-term cash flows, finding the optimal trade-off between carrying cost and shortage cost. So this is all what I want to discuss now. I'm also gonna discuss a few questions like what I did before in the last class. So I stopped sharing this and bear with me. I'm gonna share. So now we want to do some practice questions in order to learn how this gonna be work. And the first question is Prince George Corporation has a book net worth of 12,875. Long-term debt is 8,100. Net working capital other than cash is 2,750. Fixed assets are 16,590. How much cash does this company have if the current liabilities are 1,960? And what are current assets? So how much cash does the company have and what are the current assets? So we can know that the total liabilities and equity total on the other side, like the other side of the balance sheet, we can write it total liabilities and equity is this is a 12,875 plus 1,960 and plus 8,100. So all together is 22,935. That is total liabilities and equity. So we know that cash is equal to total liabilities minus the current asset and current asset other than cash and also the fixed assets. So what we can do is this is total equity, liabilities and equity 935 minus fixed assets and other than cash. So other than cash, this is our other than cash value. So other than cash, current net working capital other than cash 750 minus 16,590, which is fixed cost, minus, because this is not a current assets but it is a net working capital. So net working capital is a current assets minus current liabilities. So that's a difference. And when we subtract the difference with the with these two, which is current, which is this current liabilities and also the other than cash, this one. So we see here that these are the three subtractions, or so we get cash is equal to $1,635. That is the value we have for our cash. Now what else we want to calculate? We want to calculate current what are current assets. So current assets, net working capital is 2750 plus 1638. So net working capital is our dollar 4,385, and we can find total current assets by using the net working capital equation. And net working capital, we know that net working capital is equal to current assets minus current liabilities. So we know this value is 4,385 is equal to, we know the current liabilities, so current assets minus current liabilities is 960. So current assets altogether is $6,345. So the current assets are 6,000 including cash, so 6,345. So this question, if you see, we need to find out two things. One is a cash and the other one is a current assets. So now move on to the second question, and the second question is saying Sharla Coffee Company has projected the following quarterly sales amount to coming year. Like these are projected quarterly sales, like 820 for quarter 1, 850 for quarter 2, and Q3 is 930 and Q4 is 1010. 1010. Now, what we have to given information is account receivable at the beginning of the year is this. So beginning accounts receivable is given. So Kerala has 45 days of collection period. Calculate each collection, cash collection in each of the four quarters by completing the following. So we need to complete this all table. So for the beginning it is given, so there is no problem that we can find it out. 345 is the beginning for quarter 1 because it's starting from a previous quarter. So how much is the sales? We know that sales are 820, and how much is collected, so that's what we have to see, because 90 days are the these collection the accounts receivable, and 45 is the collection period. So we see divided by 90, half of the sales are received in the same day. So we can say that here the cash collection is 345, which is the beginning balance, plus half of which is 410. So this is going to be 755. We can write it like this way so that we can understand. So 410 is going to be the ending balance. Now 410 is a beginning balance for this quarter, and we know how much sales we're gonna made it, 520. But this one I'm gonna verbally, I just show you to calculate this figure, but we can do verbally here. We can divide this 850 into 2, which is 425 plus 410, so 835 is going to be our collection, right? So by this way, how much is the ending balance? 425. So 425 is the beginning balance for the third quarter. Third quarter sales is 930. And how much is the cash? 50% of 930, which is 465 plus 425. So 890 is the collection, cash collection, and the remaining balance is our ending balance. So this is going to be the beginning balance, and sales here is 1010. So collection is out of 50% of 505 plus 465 is 970. So we can see here 970, and the remaining balance is 505. You see, this is the way that we have to calculate in this particular example the accounts receivable. Calculate each collection in each of the following 4 quarters. So cash collections based on our accounts receivable. Now the question number 3, which is the last question we want to see here, and consider the financial statement information for Carlbo Corporation, and we see here this is inventory beginning and inventory ending, accounts receivable beginning and accounts receivable ending, accounts payable beginning, accounts payable ending, credit sales and cost of goods sold. Calculate the operating and cash cycle. So we want to figure it out, the operating and cash cycle. So you remember the cash cycle is uh, cash cycle, we can know that uh, in which we have to find out inventory turnover plus accounts receivable accounts receivable inventory period plus receivable period is our cash cycle. And when we add up or when we subtract the that's an operating cycle. Operating cycle is inventory period plus accounts receivable period, that is our operating cycle. And when we subtract the accounts payable period, then it is our cash cycle. So this is way we're gonna move forward. How do we can calculate it? So once again, operating cycle, inventory period plus accounts receivable period is an operating cycle, minus accounts payable period is our cash cycle. Operating period minus accounts payable. So we started how we can find out. First we have to find it out, inventory turnover, and that is going to be cost of goods sold divided by average inventory. So we see here that the cost of goods sold is given like 69,382. So 69,800 382 divided by average inventory. So we see inventories beginning is this, ending is this. So when we take a sum of two, or we can write it like this, 10,583 plus 12,142 divided by 2. So this is going to be whole as a denominator, and we see here the turnover is 6.1062. Now if we want to find out the inventory period, so we divide 365 over inventory turnover, inventory turnover. So we see here 365 divided by 6.1062. So we see 59.77 days. Similarly, we can go for a receivable turnover. So we see here credit sales, and we know that all sales are credit sales. Credit sales divided by average receivables. So which is 97,381 divided by 5,130 plus 5,340 divided by 2. So we get it 18.061. So receivable period, we can see 365 divided by 18.601. So we get it like 19.62 period. So operating cycle, we can see here that operating cycle is inventory period plus uh, sorry, this is days. So inventory period plus receivable period. So in our previous slide, inventory period is 59.77, 59.77 plus 19.62. So we see it's going to be 79 days for 79.40 days. That's our operating cycle period. Now one more thing we have to calculate, which is payable turnover. Same is the case what we have to see, the cost of goods sold, COGS, divided by average payable, and we see when you calculate it, you get it 9.3853 days times, and this payable period is 365 divided by 93538, so we get it 39.02 days. And if we want to find out cash cycle, so 79.40 minus 39.02, so we can see the cash cycle is 40.38 days. So by this way, I want to explain you some questions practically to show you, and I hope you will get a good idea about these